Well, good evening and welcome, everyone. My name is Doc Severson, and it's my privilege and honor to be your host and instructor tonight. We're going to be talking about how to beat the market trading weekly options. So before I get started tonight, here is our standard risk disclosure, which essentially says that if you don't treat this like a business, this will be the most expensive hobby that you'll undertake. So tonight, I will not be recommending anything for buying nor selling. And if you do find value out of tonight's presentation, please respect our intellectual property rights. If you'd like to rebroadcast this or reuse it in any manner, we're easy to work with. Please let us know first. So just shoot us a note here. Here's the contact information. Telephone support@TheoTrade.com. Please do not redistribute this without permission. Thank you. Now, some of you have worked with me before in the past. I'm seeing a lot of familiar names. Some of you have not. Some of you may be wondering, who is this Doc Severson guy? No, I did not play the trumpet for the Johnny Carson show. That is Doc Severson. So I am, among other things, I am a poster child for Rogaine, but I'm also a husband, father of three, currently still a student pilot, although one check ride away from making that into a real pilot. And I will call myself a reformed engineer. I used to be an engineer. I still am sort of, but I think differently now. I'm also, when it comes to trading, I'm the options, technical analysis, and NLP content provider. NLP stands for Neuro-Linguistic Programming. I've been with TheoTrade now for about the past year and a half. I like to think of myself as an innovator when it comes to trading education. There's a lot of people saying the same old things in the same old manners, and they're just not able to get through. So sometimes I like to be able to say things in different ways that connect with people. That's one of my specialties. I've been trading for about 21 years now. 21 years through some of the most interesting volatility or lack thereof that we've seen in the entire history of the market. And at gunpoint, I basically became an options and trading mentor about 12 years ago when I started having people show up at my front door and refusing to leave until I would teach them what I knew. Okay? I've been working with thinkorswim for about the last 11 years, so if you have any questions about that, we can certainly get past that as well too. And a couple of years ago, I wrote a book called Hacking the Holy Grail. It's available on Amazon. And this is what it looks like. So that's more about how to get past this whole concept that there is a holy grail when it comes to trading. Now, of course, I'm not the only guy at TheoTrade, right? Don Kaufman is the co-founder of TheoTrade. He's been in the business for 19 years now, 15 years at thinkorswim. Jeff Bierman joined him for several years during the swim lessons. He has been trading for 25 years. Former fund manager. Steve Slim Miller, a lot of people know Steve. Slim, AskSlim.com, 43 years in the business. Tony Rago is our NQ Futures guy. He's been trading for 24 years. Okay, and we also have on our website, we have economic articles by John Galt. Who is John Galt? Read his articles and you'll find out. Okay, so this presentation, what I found through my study into how the mind works is that the conscious mind, which is what you're listening to me with right now, loses focus about every 10 seconds. Every 10 seconds, that mind is wandering off to something else. And so it's kind of my job to keep it focused here. And so the term that I use called WIIEM, which means what's in it for me? Your mind should be saying that about every 10 seconds. What's in this for me? Is there anything in this for me? Should I be paying attention? Should I just watch the replay later? No, I want you to stick around for the next hour. You'll find it worth it. What we're going to be going over is why today's market is tough to trade. Okay, a lot of people nodding their heads out there like, yeah, this is tough to trade. What's going on here? Weekly options. Some of you have traded weekly options for. Some have not traded them before. Let's talk about what not to do first before we get into what to do. So how should we trade differently in today's market? There are certain characteristics about today's market that give you edge and some don't give you edge, especially if you're using yesterday's strategies in today's market. I will discuss 4 weekly edges to trade. Now, these are not the only 4 ones out there, but the ones that I want to talk about tonight to make sure we can bring this in within 1 hour, we'll go over 4 weekly edges that you can start taking advantage of immediately. And then, of course, at the end, we'll go into next steps, and I will take your questions at the end of tonight's presentation. So we're not going to be going about revealing some evil plot by market makers. There is no, conspiracy theory going on. We're not going to be using some secret chart study that pulls wins out of thin air. You guys are beyond that by now, right? You just want some meat and potatoes. It's about observing what's out there, understanding what the market wants, creating setups that harvest this edge. The market is always supplying you with an edge. In fact, it's trying to tell you what the edge is, but so few of us actually stop to listen to what the market actually wants. So that's kind of what we're going to do tonight. We're going to kind of peel back this thing and say, this is an edge that's currently working in today's market. And it's important that you're here tonight. So here we are during typically what is one of the lamest weeks of the year in late August. This is where everybody's trying to squeeze in their final vacation. I bet you even some of the people that are on board tonight, and we have people from all over the world dialing in tonight. Some of you are probably on vacation at this point, and you know this. You know that the best time of the year for trading is coming up soon. The next 4 months, right after we get past Labor Day, this is when the rubber hits the road. These are when we have some of the biggest moves in the market. This is where we have the greatest opportunity. And really at the end of the year, you usually look back on those 4 months and you say, wow, wasn't that something? So there's no better time than now to get ready. I'm glad you guys are here with me tonight. So a little bit about housekeeping first. I'm going to keep this short. Yes, you will get a recording of tonight's session. Guarantee it. I'm going to move very quickly through the materials so that we get to everything and we respect your time. I will not bloviate. Please hold your questions until the end of the session. Please do me a favor. Hold your questions until the end of the session. Even though I know you want an answer right then and there, please write it down, hit me up at the end of the session, or email me if you have to. So we do have staff online if you have admin questions. Jeff is out there. We've got Don out there somewhere. If you have a question, if they can answer it, they'll do so, especially if it's an admin question like, hey, my audio is not working, things like that. Okay, off we go. Part 1, why is today's market so tough to trade? And it's kind of been like this for the last, I'd say, 3-4 months now. A lot of people grousing out there going, what is going on? What's wrong with this market? Okay, so a lot of events have converged lately to create this perfect storm. And some of you may remember, not all of you were even trading 7 years ago, but some of you will remember that back in late August of 2010, exactly 7 years ago, they had the central banker Jackson Hole conference, which we just got through with last week. The last week's version was out there, right? So Ben Bernanke got things started at Jackson Hole when he came out in front of the microphone and for the first time actually publicly said, hey, guess what? We're going to be printing money, but we're calling it something cool, quantitative easing, and that's for you guys to figure out what that really means. But for the very first time, there was all these rumors out there going on like, hey, what's with the plunge protection team? What about the president's group of working markets? There was all these rumors swirling around as like whether the Fed was actually buying futures contracts or whatever, supporting the market. Well, they didn't work too well in 2008, right? But for the first time, people said, wow, they're actually going to be goosing the market. And so they started that. And you'll see exactly, if you go back to a chart from late August in 2010, the market pivoted and took off right then and there. And that wasn't the end of it. He really hit the gas pedal. There was all, Operation Twist and all those other things. And in 2013, the market really, really took off to the upside. We all know that. We're still dealing with that today because unintended consequences of those actions, unintended consequences. And who knows, at some point in the future, when we look back on history, we say, oop, maybe that was not the right thing to do. We still don't know, because right now we still have unintended consequences from that central bank action, which involves some countries still have negative interest rates. Can you imagine that? Can you imagine having your money in the bank and you're being charged interest to keep it in there? Can you imagine that? What would you do? Would you keep it in there, or would you pull it out and seek alpha somewhere? Would you seek some type of yield? And that's exactly what's going on, because if you ask the question, hey, what's out there that's actually paying yield? The answer is going to come back again and again and again. Well, let's see, fixed income instruments aren't working so well, so why don't you put it into the equity markets? And that's exactly why every little stinking dip is being bought these days, still to this day. Now, that's not going to happen forever, right? Especially if this starts to change, or if rates start to rise, we will have some change to this. But this is the way it is for right now. And this is creating what's called this musical chairs market. So you guys are aware of this from the old school days, where as long as the music's playing, you keep circling the chairs. And as long as the music's playing, you keep circling the chairs, and you keep wondering when the music's going to stop, because you better find a chair, otherwise you're out of the game. And this is what's happening with this market that continues to circle the chairs. It's a musical chairs market until the music stops. Everybody keeps wondering when the music is going to stop. Of course, it will at some point someday. All right, so we continue climbing the wall of worry. I don't know if you guys bother reading the news anymore these days, even though it's not really all that useful when it comes to trading. But what you'll generally find is a great selection of articles out there with very scary titles and headlines, such as, so-and-so envisions bear market any day now, or there's the Dr. Doom articles or whatever. And look, they've been going on for years. It's not anything new. And so what happens is everybody gets negative, everybody starts to acquire short positions, and then at great pain, they eventually squeeze them out to the upside. So we're still squeezing out to the upside with this wall of worry. Today itself was a great example of that one more time. So overnight negative news gets squeezed out to the upside. We continue climbing this wall of worry. So let's look at the S&P market here. Over the last year, 252 days, right? 252 days. So starting a year ago, over the next 252 days that we've had 1, 2, 3, 4 viable swings to the upside on the S&P. And you'll also notice that they're getting smaller and smaller and smaller. They're lasting not as long. They're getting more abbreviated. They're leading towards longer and longer consolidations. So if you actually do the math, and this has changed quite a bit from this spring, so out of 252 days, only 38 of them are trending days. Only 38 of them are contributing to any form of trending movement. The rest of them, 85% of this is sideways. So that is as of today. So do you really want to be buying at the highs? Facebook, do you really want to buy Facebook at the all-time highs? Most people, I would say, no, it's not a good idea. You know how this ends, right? Here's Apple, okay? Are we going to see the same thing happen to Apple again as we sell into their announcement one more time? So a lot of people get to this point and they say, well, look, I really don't want to be buying anything. I don't want to be selling puts at all-time highs. I don't want to be acquiring stock at all-time highs. That's probably a bad idea. So if the market's going sideways 85% of the time, I should be selling options premium, right? I should be doing something like calendar spreads, iron condors, setting up ranges that the price can trade within, and then I should be able to win 80, 90% of the time. This should be great, right? The problem here is that we have decades low values on volatility. Look at this. We had recently a VIX of 8.84. I thought it was bad back in 2007 when we basically cracked into the single digits, but now it's even lower than that. What does that mean? That means that risk premium is basically on the floor. It's in the gutter. It is very, very low. And that is going to affect how much you pay for options or how much you sell them for. And if you're selling premium, you're not going to get much for those. It's like selling hurricane insurance up in Montana. Right? So look at these lows here. So the problem is that you're going to be hand-to-hand combat with the price. So if the price is up here, just sort of chopping around, you're not going to be setting up positions that are very far. If you set up a condor or something like that, they're not going to be very far out of the money. It's only going to be a day's travel before you get run through on these things. Believe me, I've been through that before. It's not fun. Don't want to do that again. So you're playing hand-to-hand combat with a price, which is never a great thing to see when you're selling premium. You want something more in there. You want basically the implied volatility to be so overinflated compared to the realized that you have a very easy month. Not so these days. So here's some of the problems that we have to solve trading today's market. These are the problems that we have to solve. I'm a former reformed engineer applying problem-solving analysis towards this. So the price is at or near all-time highs. Not a great place to be buying something right now. Stocks are therefore kind of expensive. In fact, very expensive. So what are you going to do? Like buy one share of Amazon with your money? Most stocks are leading the market are just incredibly expensive, right? Three to four figures. If you blink, you miss the trends. It's really tough to catch the breakouts in the trends. They usually gap overnight and then they're gone. They're gap and they go. You've got 5 days to get some meat out of that trend and then it's sideways for another month or two. We're not being paid well enough to take the risk of selling premium. I'm one of those guys that 5-10 years ago was going on and on and on about the benefits of becoming an insurance company, basically selling premium in the marketplace, which is a very conservative business as long as you can manage your risk. And these days, for the past year, I've been dry on this. I have not sold any credit spreads on a longer-term basis since the Brexit, right? That was the last time that we had adequate conditions to sell premium like that. Okay, there's other ways to do it though. That's what tonight is going to be about. So to some, this is just too much of a challenge to overcome. They just wave the white flag and they just don't know what to do. So they go backwards. They join the herd. They say, well, how bad could it be? I'll just put my money into Fidelity, Magellan, and hang up my spurs. Let's not do that. Let's not pay those fees. We can fix this. So how we do this is we have to match the character of the market, right? We have to trade what's here today. We don't have to use yesterday's tools. They will not work in today's market. So let's talk about solutions for a low volatility, compressed range market, okay? So part two, I'm going to tell you first what not to do, how not to do it. Okay, and many of these ways have been ways that I still see emailed just about every day with somebody using a narrative that's maybe 10 years old. And this is why I call them yesterday's solutions to trade today's market. So when most traders think of weekly options, this is kind of the narrative that most people have communicated about weekly options. Weekly options are really no different than monthlies. They just occur more often. Right? Selling credit spreads every week. So you'll probably look through your inbox and you'll see somebody positioning selling credit spreads every week. More on that later. What you'll also see is that market makers are pinning the price at high open interest strikes. So these are two strategies that I see continually still being positioned in today's market. So again, let's talk about what not to do first before we get into solutions. So number one, selling weekly out-of-the-money credit spreads. And typically what you're being told is that you're getting about an 80% win rate, which is, of course, due to the math. That's fine. Okay, so if you just follow the math, you'll get about an 80% win rate, right? So these are a great confidence booster. And during more volatile markets, these are These are great. I mean, I love these trades, right? So the first time that you do one of these things, you set up a strike below the current support level and you say, well, look at that great support level down there at 142.5. Let's sell a credit spread down here. Put credit spread and you watch as the price runs away and expires for full profit. Terrific, okay? One notch in your belt. So after your first one, you're going to have confidence to play the next one. Oh, look at that support level down there at 152.5. Terrific. Let's sell another credit spread. So your confidence starts to expand, right? So you start to get more and more wins notched up. You start to play more aggressively. You start to play multiple cycles. You're leapfrogging your positions, more than one at a time. You're starting to leverage more and more of your account. And in fact, you're starting to trade bigger and bigger positions. So it's not uncommon to feel as if you found the Holy Grail itself at this point. Trust me, guys, I've been through this before, right? You start to lever up position size. And it's almost predictable that you start to lever up position size right before the inevitable happens. Quite suddenly, the party ends. All those prior profits have evaporated. So typically, if you're winning 80% of the time, those 20% of losses will usually more than eat up those 80% of profits. And especially since the last losses are usually made with bigger positions, because after you get confident, you start to over-lever it, you forget about risk management. And so it's normally the case where the 20% of losses will more than wipe out any prior profits. How demoralizing. Let's not do that anymore. So there's nothing wrong with credit spreads, right? However, there is a time and a place to use them. Selling risk premium in complacent times does not give you a good edge. It makes more sense to be a net buyer of risk premium when it's low like this. Maybe you've been told that, maybe not. I still see the messages out there all the time saying never buy an option again. This is not the time to do that, guys. Number 2. Market makers pinning the price at high open interest levels. Okay, so you've been taught this for years now. Look for those weekly options expirations, find those high open interest strike prices, and then put on a strangle. The price will stay pinned right at that strike, and you can just, forget about watching them. You can go off and play golf on Fridays, right? First of all, what I just have one request here is that can we get past this fictional perception of market makers as being some evil dude? Pay no attention to that man behind the curtain. And this has been going on for years and years and years, and it's just not true anymore. The market maker is you, it's me, it's all of us. There is a market for every option that's out there, all right? So if that particular option has a very wide market, it's not just because some dude is being evil. It's because there's basically no bid on that. There's no demand for that option, right? So trade options that are liquid. Don't worry about the market maker. We follow a list of stocks that have demonstrated liquidity with weekly options. We use them every day, right? There's no reason to trade anything else. So if we look at this option chain, where's Apple going to pin it? I don't know. There's a lot of high open interest strikes here. All I know is that with 3 days left of trading, that it's got a plus minus 2.5 or 2.6 point expected move. You're not going to be able to find a pin here on Apple. So it used to be statistically significant. When we had fewer cycles of this, it used to be a big deal because you only had an occasional expiration, right? Maybe you had one weekly and then several monthlies, and it used to be a big deal. It's no longer a big deal. The risk is so spread out now that it's not all coming down to one weekly expiration. So there is some evidence that the underlying price will draw to a strike price by expiry, but that's more likely due to hedging that occurs. So it's delta hedging, which is effectively managing risk, and it ends up, pushing around the underlying slightly because of that. So let's stop trading as if it's still 2007, okay? Let's trade today's edges and not ones that don't work anymore. Okay, so now we're getting to part 3, how to execute differently in today's market. How to execute differently. So part 1 was what's the problem with the market? Part 2 was how not to do this. Part 3, what do we have to do differently now? So what should we do to grab edge in today's market? I submit to you 3 different considerations for you to think about. Okay, risk management is always going to be number 1 in our book. Risk management, number 1. Number 2, evaluation of market character. What on earth is market character? I'll get to that in just a second here. And then talking about a statistical edge. So 3 different considerations for you to talk about. Now, if you're going into risk management, what we do here, and this is what we will always do in this type of market, is define our risk, right? Risks are defined before placing the trade. And I'm not talking about setting up a trade with perhaps a 1 to 8 or 1 to 9 reward to risk. Nope, these are 1 to 1 or better. We're doing 1 to 1 risk reward or better on these. So we've defined them such that we can walk away from the trade and know precisely what our maximum risk is. How else can you trade in today's market? There's just too many undefined risks of price movement. So the risks that we have to factor in and include changes in price, time, and volatility, of course. Again, please never use asymmetric risk in today's market. If somebody is out there selling you on setting up 10 delta strikes on iron condors, it is not if, it's a matter of when you're going to get run over in today's market. It's just not the right market for it, right? Range contraction like this leads to range expansion. It will range expand through your position, and then you're going to be calling me up saying, hey, Doc, what do you do if the price is beyond your vertical spread? What do you do? Is there some kind of secret adjustment technique that you can use for that? No, you cannot. Without taking too much risk in the opposite direction, you can't do that. I would rather you play peace. I would rather you play defense during times of peace than war, right? We also want to reduce our time exposure. The reason for that is because the longer that we have a position out there, the longer that we're going to be risking adverse price movement. So you're hearing the same kind of thing from me over and over and over again, is that we're going to expect to see from these very sideways coiling conditions, range contraction like this leads to range expansion in the extreme. So it's only a matter of time, right? And then, of course, liquidity. We want to make sure that anything that we trade is going to have exceptional liquidity such that we can get out so that we don't create this, what we call this roach motel, right? You can check into the position, but when it's time to get out of it, you cannot get out. And that is especially a problem in today's market. We've seen a lot of volume actually going out of today's market and being concentrated into a small subset of underlying stocks. So just because something looks good on a price chart doesn't mean that you should be trading it with options if the liquidity isn't there. You don't want to be the only person on that bid or offer. All right, now part 2 now is market character. Right now the market is quiet and trending. There's 4 different types of character that I talk about at TheoTrade. Quiet and trending is what we're in right now. Okay, this is typically when you see very linear price movements like this. Very linear price movements, the same kind of thing again and again. Usually it's going between range contraction to range expansion, range contraction, range expansion, range contraction, range expansion. And even when it starts to move lower, it's still very, very quiet. Okay, so that's quiet and trending, and typically we'll see that around 80% of the time. Now, what it usually migrates to is volatile and sideways. So the initial move down, what I call the shot over the bow, translates into that first transition into volatile and sideways. If you want to see a good example of that, look at the entire time frame that we had between August of 2015 and basically the end of June 2016 where the Brexit reaction was. So we had about a year of what's called volatile and sideways. Big range, right? 300-point range in the S&P. A lot of movement, a lot of swings up and down, right? A lot of roller coaster price action. This is volatile and sideways. Now, sometimes you'll actually go to condition number 3. This doesn't happen all that often, especially in today's world of, quantitative easing. You'll actually migrate into volatile and trending, which is another word for a bear or corrective market. So we saw a little bit of this in 2010, a little bit more of this in 2011, and honestly, we have not seen it since that point. Obviously, the best example for that is the 2008 bear market. Okay, so those are 3 different types of character. There is one additional form of character which we don't see all that often, and it is quiet and sideways. So quiet and sideways markets, if you want to look at the summer of 2015. So the summer of 2015, right before it released, was quiet and sideways. We've had occasional bouts of quiet and sideways, but usually it's the big 3. So quiet and trending, volatile and sideways, and then volatile and trending, with the majority of the price action that we've seen over the last 10 years is really bounded by these 2 and occasionally the third one over here, the downside movement. Okay, catching those rare big swings is difficult to do. So right now, again, we're in quiet and trending. It leads to inactivity and impatience for most. This is where it drives people crazy because they can't stand the wait. They're waiting, and all of a sudden the thing is gone. Or look at this. I mean, this is a good example of this, is where we have, the gap and go. We get a 2-day trend and then it's over. It's gone. Or this one, gaps and goes, it's over before you know it. Here's another gap and go, 5 days, and that's it. So most people are just getting impatient waiting for this, and they tend to overtrade and look for things that are not there. But would you agree that movement is opportunity, though? Right? Movement is opportunity. As traders, all we should care about is movement, or lack of movement if we're paid appropriately for it. Lack of movement if we're paid appropriately for taking on that risk. So if we move down in time frame, it looks like a totally different chart, right? So I just went down to a 60-minute chart, and all of a sudden this looks like it's exploding here. All kinds of volatility in a 60-minute chart. So that's one of our answers, that we can kind of move down in time frame and discover a new level of volatility. That does put different requirements on the trader, though. So narrowing our focus, but doing so with defined risk positions, allows us to get in, get our fair share, and then get out before the character changes again. So this is the big risk today, is that, and I've seen this so many times, is that when the character changes, it's kind of like the seasons change. When winter hits, all of a sudden it's like, oh, where did that come from? And during a character change, if you've traded through anything like August of 2015 or February of 2007 or May of 2010 or any of these other times when the character changes, this is what always catches the retail trader off guard. You've got to plan for it. You've got to anticipate it. You've got to mitigate those risks before they happen. So now we get into part 4, and this is where some of the rubber hits the road. What are some edges that we can trade against today? Okay, so these are the 4. So some are statistical or chain-based, so option chain-based, right? Some are technicals, which are chart-based. In the end, to me, they're all statistical. So I don't look at a chart as being, reading the tea leaves or anything like that. I base everything based on price action. If you base it on price action, if you base it on statistics, range expansion leads to range contraction and vice versa. It's statistics. It's a probability factor. So let's see some examples of short-term trading edges that are working. So here's what you came here for. So number 1 is the expected move. The expected move, okay? So what we do is we track the expected move on a weekly basis for things like the S&P 500. So we specifically track the S&P 500, spiders. It doesn't matter whether you use the spiders or the SPX, just watch out for the dividends, right? So the expected move is basically the market saying, I've priced in this expected move. And so what we're looking for, that expected move, is generally, we're looking for plus minus 1 standard deviation around the starting point of the price. And what we've found through a lot of statistics and a lot of trades here is that typically these plus minus 1 standard deviation price points are well known, just like a trend line on a chart or just like a resistance or support level on a chart. They're well known. Everybody knows about them and tends to defend those areas fairly well. It's a statistical edge. Okay, so the weekly expected move is a solid framework to create trades every week. What do we do with that? We fade those levels. We're trading to the targets or fading a level once hit. Not as much trading to the targets, so rarely do we have that much of a great view on the market to say, wow, we're in the midst of a great big trend and we can just, set up a target at the opposite end. That's not working in today's market, but fading a level once hit is working very, very well. What I like about this as well too is a lot of us are out there trading so many different strategies and so many different stocks and so many different things. We all end up becoming a jack of all trades and a master of none. It happens all the time. We're always looking for that holy grail, right? So by doing one thing with one stock every single week, this is going to give you expertise and mastery in a very short period of time. You're going to be doing the same thing over and over and over again. You're going to get repetition. Repetition is the mother of skill, my friends. So emphasis is on using defined risk spreads. I know exactly how much I'm risking when I get into the trade and what I'm looking for as a profit. So it's a statistics-based edge with no charting, no technical expertise required. It's either going to hit that level or you're going to fade it, right? You know what you're looking for in terms of profit. So here's an example trade, and in this case, what we did was instead of using a defined risk spread, this was actually on expiration day, so there's no point in setting up a spread. There's so little theta risk and vega risk on this option that we just went ahead and bought a call option in this case. We faded the downside expected move target with a 242.5 call for a 28-cent debit. That is my risk on the entire trade, 28 bucks a contract. Okay, 114% return on capital after commissions, hold time 4 minutes. So all I was looking for was to get 100% return on that, and it moved very, very quickly. So most of our expected move fades take longer. Usually they're more of an overnight affair, and they do use debit spreads, so they go very, very slowly, but the principle is the same. Here's weekly edge number 2. Now, one of the studies that we use here at TheoTrade, which is called it's got a long name here, the RSILaGuerre with embedded fractal energy. So what is that? That is 2 parts to it. So the embedded fractal energy, let me start from the back here. This is the yellow line. This is what we call the fractal energy study. So basically what this shows is a market that's going sideways, has got a great deal of energy, a market that has been trending, has very low energy, and is unlikely to remain trending in that same direction. So this gives us context on the chart. And then what we have here is the RSI. So this is a standard RSI, but it's using, instead of linear time, instead of 14 or 2-bar look back, which is what just about every other study uses, it's using the Laguerre time transfer. It's very, very responsive to changes in price action. It becomes a much more adaptive and responsive binary signal. Here's a short signal. Here's a short signal, here's long signals, right, hooking up from the bottom. So that's the RSILaGuerre with embedded fractal energy. So what can we do with this study? So this is the most accurate study that we back tested. This thing is really good. So the embedded fractal energy component provides context. So range contraction and ready to trend again. So this is where we see a market that's doing this kind of thing when it's just, railroad tracks just chopping back and forth. Like this is where the spring is being wound up tighter and tighter and is getting ready to trend again. Or we have the converse of that, which is range expansion and ready to consolidate. So think about the applications for that. If you knew with a certain probability when a trend that had gone parabolic was more than likely to move into a sideways consolidation. Again, great applications when it comes to options for this study. So the RSILaGuerre, again, the Laguerre time transform, which is more responsive, as I said before, we can actually scan a qualified list of stocks with specific conditions for this study. This is great because we can let the platform do all the work for us instead of going through and manually checking the watch lists again and again. Now what you'll find on this is that the hits on this scan are very rapid, very accurate. They age quickly. They're not something where you can sit around and wonder what to do with them. Usually they're moving very, very fast by this point. You can also dial this down in time frame. Right, so here's an example. This is a signal showing today on Baba, right, Alibaba. As it fades down from the highs, we have an exhaustion signal here on the fractal energy, and we have, of course, the hook down here on the RSI. Okay, so I was alerted yesterday on this one. Baba was added to RSILaGuerre bearish scan. So it emails this to me as soon as the RSI starts to break out of and hook down out of the oversold zone, or overbought zone, excuse me. So when the scan fires and the setup is confirmed, a limited risk bearish trade would be entered. Here's another example like on a 60-minute chart. So we have exhaustion down here and we have the hook down. This is a valid signal for a short or in this case, a long put option. Okay, enter for 35 cents. Again, limited risk, limited risk, limited risk. I keep saying that. We know exactly what we're risking on this trade when we enter it. We can walk away from this if we have to. Okay, so the weekly edge here with the RSILaGuerre with embedded fractal energy is meant to capture very short-term edges in the marketplace. These are not long swings that you're going to be holding for a long time. These are very short-term, very rapid. We're going to be using defined risk spreads with no asymmetric risk, 1-to-1 or better. So scans are employed to take the work out of finding this. And the output of that scan is pushed to my inbox. It can be sent to my phone through SMS, whatever have you. Scans are only made against a defined list of highly liquid stocks. I'm going to keep saying that again and again. We're not going to scan all 8,000 stocks out there. We get way too many signals, way too much garbage, and lousy option chains. There's lots of illiquid option chains out there these days. Be careful. Watch out for those roach motels. The number 3 weekly edge here is the short call diagonal, the short call diagonal. Now what I like about this trade is that it's long Vega, long Vega. So what happens is it's a bearish trade. Think about what happens when a stock goes from a parabolic move like this and starts to move down. What happens to implied volatility? It goes up. So what actually happens to the profit and loss diagram of a trade like this when net implied volatility goes up, it will actually stretch out the profitable area of the trade. Many of you are used to just dealing with vertical spreads, and the vertical spreads do not change the profit and loss expiration graph, but they will with time spreads like this, the short call diagonal. So it's a very kind of a niche, very purpose-built trade that we have here. And what I'm generally looking for is for the price to come slamming up to all-time highs or a recent high like this and then fade down from that level. So it's a very purposeful trade which matches today's conditions, right? We have a lot of stocks that are slamming up to all-time highs or some type of form of resistance point. We also have very, very low implied volatility, so that favors a long Vega trade like this. Okay, so the edge here for the short call diagonal is meant to capture very short-term edges in the marketplace with price stalling at resistance, right? Again, defined risk spreads are used with no asymmetric risk. We want to get that one-to-one, looking to get in, get our fair share, and get out of this. So scans are employed to take the work out of finding trade setups. We don't have to sit there and pick through a watch list every day or every weekend like we used to do, right? Just sit back and let the machine do all the work for you. Spend your time programming it effectively, as we've already done. So scans are only made against a defined list of highly liquid stocks. Once again, we have to make sure that we're trading against something that's going to give us a good edge when it comes to the options. And now we get to number 4, the weekly edge here, the enhanced RSI2, the enhanced RSI2 strategy. So many of you have heard the RSI2 strategy. You've heard this name before, and you'll know that Larry Connors originally built this many, many years ago, but it was only meant for the spiders. It was only meant for the S&P 500 ETF, and he initially just wrote it for stock ETF trades, and then he eventually amended it to include long call options as well too. Okay, so we can scan against our tight list of liquid stocks and look for scan output, which implies a rapid pullback. But what I've done is we wanted to do a little bit more than that. We wanted to add we wanted to turn this thing up to 11, if you will. Okay, so what we've done is not only use the RSI2. So here's the RSI2. It's just simply an RSI Wilder with a period of 2. And you're looking for a level below 5.0. So here's a good example of this. Here is a signal here, and this is one of Larry's original signals, and this is all the reaction that you got from that move. That's it. But you'll also notice that the energy level at this point was still fairly high because all of this is just sideways movement. So what we add is a little bit more stringent entry criteria. We want to see something that not only is showing an RSI2 below 5.0, but also what I consider to be exhaustion, downside exhaustion on this. Now we also have to be above the 200-day moving average. That's what this green line is. When we have all of these 3 in place, then we are green light for a long. And we're not looking to, we're not looking to get pigs here. We're looking to get a quick in and out on these types of trades. Yeah, typically they are debit spreads for things like this. Okay, so here's the signal, 1, 2, 3, boom, you're in and out. So here's another example of an enhanced RSI trade, and you'll see the answer to this. This is a vertical call spread, right? So a vertical call spread. The most that we're risking on this trade is the amount that we placed putting it in. So a 48-cent debit, that's the most we could ever possibly lose on this trade if the trade just continued to dive lower and did not allow us a way to get out of this. So the debit spread was entered for 48-cent debit, closed 5 days later for a 31.2% net return on capital after commissions. All right, so let's summarize. Let's wrap this thing up and get you on your way here. So realize that implied volatility is low. Risk remains high. If you don't think it's a high risk market, please reconsider. Selling out of the money premium is not worth the risk today. We need to find one edge where it is today and not forfeit strategies. We don't want to be pounding that square peg into a round hole like so many people are doing today. We can also shorten our time horizon and reduce risk by doing so. If we're not in the market when it moves and moves significantly, then we have nothing at risk. We can find statistical and technical setups to accomplish this. So we can balance them, whether you're a stat trader, quant trader, or a technical trader, whatever fits your bill, all while using defined risk strategies. So that's the one thing that we really focus on here at TheoTrade is defined risk strategies. We don't do those asymmetric, way out of the money things, especially not in today's market. So eventually the movement implied vol will return. We know it's going to return. It'll come back, but we can't sit there on the sidelines waiting for that black swan, sitting on the, for years. It could take a long, long time, right? So now let's put it all together. Part 5. Today's market has been difficult to trade for many reasons. Most people agree with this. Trends are rare, ranges are small, their risk is high, volatility is low, implied volatility is on the floor, complacency and risk is high. Our priority is to proactively anticipate risks in this environment and not just trade based on hopium. Number 3, prices are climbing the wall of worry. Retail and funds are being forced to buy at the highs. They're basically being forced to hold their nose and jump in. And no, it's not different this time. It will always end the same way. Number 4, we can better manage our risk by bringing our time frames down as well as our hold times. So shorter time frames, shorter hold times, more opportunity, in and out faster. Number 5, we are better off by being net buyers of options and not net sellers. Now, 3 years ago, I would never have agreed with this, but today, this is what we have to deal with. This is the truth, folks. Number 6, we want to be trading fixed risk positions where we can anticipate a character change without fear of the swan. How many of you have held credit spreads and you can't sleep through the night? You keep waking up at 2 in the morning to check the futures because you're nervous about what might happen. Those of you that had credit spreads on during the election evening probably were regretting that, right? So if you have a fixed risk position, you don't care. You don't care. It's an entirely different liberating feeling. Number 7, we can find new edges based on statistics and the expected move. Hello. Number 8, we can also find short-term edge based on scans that can alert us to short-term opportunities. Let the platform do the work. Let the platform do the work. You don't have to sit there and say, oh, there it was. So now, guys, I've just told you everything you need to know to start applying concepts of your own to create a weekly option system. If you're like me, though, you may want to go deeper as the edge is in the details that we've learned over the years. So right now, you're probably asking questions like, I haven't had a chance to look through the questions in the room yet, but you're probably saying, hey, what about how do I calculate the expected move? What makes a good signal? What time frames do I use? What about that fractal energy signal? How do I evaluate that in the context of different time frames and price movement and the RSI signal? How do I create a scan, right? So we do have these answers. We can show you how to filter out the highest liquidity stocks. We can show you how to improve the probability on the scan results. What types of spreads provide this fixed risk opportunity, right? How can you be notified when your scan produces a result? How do you do that? Some of you just want to know, well, look, could you just show me how you do this? I don't want to have to reinvent the wheel. Just show me what you're doing. Okay, we do have your answers to this. This is what we do, guys. Without hype, without upsells or anything like this, we build strategies with definitive criteria, instructional videos, checklists for every strategy. We pick these things apart. We show you exactly how to do it. And we also do it live every day in our chat room. We're on live anywhere from 5 to 7 hours every single day during our chat room. Okay, those are not only live, but also if you can't make it live, you can attend in the archive. Okay, so we show you how and when and why and what signals and everything else that we do here. So this is just the beginning of the many variables that you'll find with this. So there's only so much that I can share with you in 50 minutes here, right? So the secret's in the details. Now, a lot of you, and I was kind of the same way too, I said, hey, I can do this on my own. I'm an engineer, right? But how much capital are you willing to risk to find those answers? You know, when I show you the solution to this, it may make the point moot, hopefully. So these strategies and corresponding criteria, you have to have contextual understanding to apply properly. It's not just a red arrow and a green arrow kind of thing, right? We've spent years adapting this methodology to our trading. Our secret is our ability to communicate this in a simple manner. So we really do try, it's not about us, it's about you. So if you'd like the criteria to add this analysis framework strategy to your trading, we have a solution to you. Okay, I'd like you to join me in the Weekly Options Trading Advantage class. I am the instructor for this. The class is accessible immediately, so you can actually get this tonight, and it's available indefinitely. Now, I want you to think about this for a second, because so that alone is a 3.5-hour class. But then what you're also going to get for this, and this is for a grand total of $97. So if you go out to TheoTrade.com/WO, this is where you're going to find this offer. But listen to this for a second. You're going to have a 5-part class, 5 hours of instruction on fractal energy trading. So if you liked what I was saying before in terms of that range contraction, range expansion, understanding the energy, watching price move, range expansion leads to range contraction. How do I take advantage of that? How do I scan against something like that? That's in the 5-part $150 class, right? We also have Don Kaufman teaching you Options 101. So maybe some of this is a little bit new to you, but the one thing that we always say is that even if you've been trading for years, you will learn something from the Options 101 class. Again, 5 hours of instruction for that alone. And also Don goes into the Weekly Options mini class, another 5-hour class. So if you want to learn more about options from more of a, I would say, a stat and quant perspective. Don is much more in the stat and quant perspective than I am. I'm much more on the technical side. One of my mini classes that I've done, again, 3 hours, is on the short call diagonals. Most people don't know anything about the short call diagonals and how to set them up, how to scan for them, and what conditions work really well. So here's something that's cool too. All studies and scans that we have, we're going to include with the class. Everything is out there, right, for the same price. There's no upsells here. We have them all for thinkorswim. We have a couple for TradeStation. No scans for TradeStation, just the study itself. And also the final bonus here is listen to a full day live archive of these trades. So we picked one day and we said, all right, we're going to dedicate one day and all 4 instructors to talking about these trades, right? So all of this is out there. Again, if you go to TheoTrade.com/WO, and let's talk about, again, what you get for this, and then I will get into your questions in just a second here. All right, so let's look at this here. If we go out to this site, TheoTrade.com/WO, what are you going to see out here? Let's walk through this. So think about all the benefits of what you're getting for $97. You can get this right now. If you go to the add to cart right now, you get all of this information. I added it up. It was 24 hours of information, 24 hours of information, okay? All of it very high quality, very archivable, right? HD video. Okay, so what you're going to learn is how to use weekly options to find consistent edges. We're going to go into the 4 weekly option trading strategies that I went over this. How to minimize your risk in quiet markets. How to use these statistical probabilities, right? So how to set up those weekly expected move targets. Market insights to let you know how to deal with quiet markets, okay? We're going to give you all the tools and strategies for analyzing any market condition. How you can trade this intraday, okay? Which stocks are those ones that offer high liquidity? Which ones are the ones that we trade, okay? What strike prices, what expirations are you going to be using? The exact entry and exit criteria, okay? How to create scans for these separate strategies. This is important, right? This is really, really important. Automation is coming into everything that we do these days. If you don't know how to automate, you're going to be wasting your time. You have to be able to automate to go against the other houses, right? So we have the same power now that institutions had at their disposal 10 years ago. How to use that RSI timing tool. How to use fractal energy trading, all right? This is an extremely powerful concept, right? Okay, so all of these benefits come to you tonight if you sign up. It's going to be a lot to work through. I think you're going to find an extreme amount of value for a very low investment, okay? So we've already been over the bonuses. Now, what I'd like you to consider doing is, if you do make that investment, you can apply that investment towards a Total Theo 12-month mentorship for this. So this is something that all the people in our room on a daily basis have already signed up for 12-month Total Theo. So again, for $9.97, we'll give you a credit for this class if you want to sign up for it later. We have just, probably the best way that I should do this here is to show you an example of what we have in our members area here. So if I go out to the members area, here's the member chat room that you can see. And the great thing about this is it's a full community, right? So there's live video, 5 to 6 hours a day, 5 to 6 hours a day of live video. And then we have all of the members and the moderators chatting live, going through the trades that we're looking at, right? So this is a full community that we're all, sharing the same experiences. We're looking at the same markets and we're saying what to do here, when to trade, when not to trade. If you go out to the archives, some of the classes that we have out here, just a huge amount of information. So this is, again, if you signed up for the full Total Theo class, right? Look at all the classes that we have out here. Butterfly Guide to Weekly Diagonal Spreads for Consistent Income, Small Account Trading Workshop, RSI Unleashed, Fractal Energy Trading, Increasing Vertical Spread Probabilities with Technical Analysis. Each one of these is at least a 3-hour class. We have more quality information for you guys than you'll be able to go through in a whole week. If you want to know about the Ichimoku Cloud, we'll teach you about the Ichimoku Cloud, about Option Greeks, Fundamentals 101, how to scan for fundamentals, right? So a class that we just did a couple of weeks ago, Beginner's Guide to Ratio Butterflies. So just an amazing amount of information that's out there, as well as being live about 6 hours a day. Okay, so with that, I invite you guys again to go out to TheoTrade.com/WO. Okay, TheoTrade.com/WO. Check that out. Again, full credit of the class cost to a 12-month Total Theo membership. So with that, my friends, I will take your questions now. I appreciate your attention and letting me come into your living rooms this evening and talking about weekly options.